Good evening. Today we discuss yet another topic which is called index replication strategies. Now, first of all, let me first explain to you what is index replication strategy. Ladies and gentlemen, this strategy is only for high net worth individual. More importantly, this strategy is not for a retail investor. And before you make up your mind, this strategy I'm talking as country agnostic. Now, what do you mean by country agnostic? By country agnostic, I means this strategy is not about a single country or any single index of any single country. This strategy can be used worldwide. But having said that, this strategy is highly technical in nature. And more importantly, this strategy is quite expensive in nature also. Now, what is index replication strategy? Now, let's assume there is an index in XYZ country and that index cover 20 securities. Let's assume. And you feel that you are supposed to cover, your portfolio should cover all the 20 securities. Now, what is a way? The very simplest way is to invest in ETF market, which is exchange traded fund. And when you invest in ETF market, there are two type of ETFs which are technically there. Number one is the active ETFs. Number two is the passive ETFs. But that's a debatable point that in the last several years, the quantum of passive ETFs grown like this, and the active ETFs are more or less intact. More importantly, when it comes to ETFs, and especially when it comes to passive ETFs, then they keep their tracking error, which means the divergence between the whatever the index is making and whatever that relevant ETF is making as low as possible. It is fairly impossible and a complicated process to keep the tracking error zero. And I strongly feel that if you're able to maintain tracking error zero, then you are a super investment manager of the globe. But anyways, that's really a debatable point. Second is what I can do. If I'm a big investor, high net worth individual or accredited investor, then I buy all 20 securities as per my portfolio. Now, the quantum of that security, I decide myself whether I wish to buy, in a very huge quantity or I wish to buy in a low quantity. That I decide myself. And then I would be doing a buy right. Because buy I already done. I already bought that. The right I would be doing to make sure that in case the index falls, I won't be losing. But that's really a very debatable point that why buy right is required. There are two kind of investors which we are having, and like I said, this is country agnostic. This video has nothing to do with a specific country. We are teaching a technical and a fundamental point. There are two kind of countries which we are having. Number one country, two type of investors. Number one is definitely the investors who believe in futures and options. They take futures and options and they keep their position open. So one day they are in gain, another day they are in losses. And they are quite happy with that. They are happy that if for 2 or 3 days in a month they are losing, they are comfortable with this. Second kind of investor is those who take the cash positions. Cash position, which means that today you bought one security, say Apple, simplistically at 146. And God forbid, due to certain reasons, Apple end up become 130. Then you are losing the cash piece of that, which is the $16. It's a cash piece. You continue to hold. The day you get whatever price you're thinking is the right price to sell, you sell and make the profit. Now, if an investor who is doing the index replication strategy, if he is doing as a cash investor, then there is no need of buy right. No need of buy right, which means you buy and hold. But there's a very important thing which is called patience. And patience is something which we need to learn over the period of the time. We feel that the patience is inbuilt in nature, but I'm sorry, patience is something you need to build over the period of the time. Second piece is that if you are doing the right, then you need to decide whether you would be selling the put or you would be selling the call. Because in either of the cases, you would be earning what is called the premium, whether you would be selling the put or you would be selling the call. But when you would be selling the put, that remember, the party on the other side has a right to sell, which means buy put. It means you are obliged to buy. So that obligation is always yours. And for that obligation, you are having the option premium, which practically means that gains are limited to the extent, but losses are outrightly unlimited. So, God forbid, if the index flung by 20%, any geopolitical issue, any war, or maybe any political or any other factor of any country, then the valuation fall, and that person, other side party, would definitely exercise his right, and here you gone, because the premium which you have received would be far lesser than the amount you end up paying. And God forbid, if due to any plus reasons the market went up and up, then in that sense the sell put will never get exercised and you get the premium. Henceforth, I strongly feel that in an index replication strategy, when it comes to the first piece, whether you would be doing the sell put or sell call will be coming in the next video, that call you are supposed to take. And remember that should not be emotional in the sense that you're supposed to take this call, that are you able to take the risk which is there in the sell call, in the sell put, because that losses are unlimited in nature. Please take a note of that. And that you need to learn. This is very important. The second piece in the buy right, which whereby I technically differ from the theory and the books, is that you can also do the sell call. But ladies and gentlemen, there is a problem in the sell call. The same problem. The profits are limited, but the losses are exorbitantly high. So let me give an example that suppose there is a country XYZ who are having PQR index, and this index is currently trading at a throwaway price for a minute. And let's assume that since this is trading at a throwaway price, in this eventuality, you think that you should be buying that. But there's a technical concept in the world called reversal point. And that reversal point concept is really very tricky concept in the sense that you're not aware that what the hell is the reversal point. Reversal point is the mechanism from where the market wents up. I further repeat, this is country agnostic. Now, suppose the index is falling like this, and this is not the reversal point. The reversal point is here, down to that, and you bought here and the market fall. No one in the world is aware about the reversal point. No one in the world is aware about the reversal point. The reason behind that, because reversal points are very difficult to track. The big investor, the big trading houses who invest a huge quantum of the money, they decide about the reversal point. We are no one to decide about the reversal point because this is beyond our jurisdiction. We are price takers. We are not the price makers. Go with the same example. You bought the 20 stocks in a relevant XYZ index, and after that, you think that you got it at throwaway prices and the market went up. You thought this is not a reversal point. Reversal point maybe sometime later, and market went up. Since you are in a sell call, which means the party on the other side, which is buy call, right to buy, and market went up, he would be definitely buying that. He would be definitely exercising that. And since he would be definitely exercising that, you're gone. Because your profits are quite limited in nature while the losses are exorbitant in nature. So what you would be doing in that sense, you would be losing it. Henceforth, ladies and gentlemen, let me summarize that when it comes to replication strategies, then we really need to understand that replication strategy is nothing but when you are replicating an index, but having said that, you would be hedging yourself. But like I said, there are many issues in that. The number one issue is that whether you are a cash investor or whether you are a F&O investor. Because if you're a cash investor, in this eventuality, the buy right is definitely not applicable. But having said that, if you are a F&O investor, then it is definitely applicable. But remember, when we are creating index replication strategies in this eventuality, one thing which we're supposed to be aware is that index replication strategies is coming up with an exorbitant cost. And that exorbitant cost is very, very important thing which we're supposed to consider. But ladies and gentlemen, there is another important thing which we need to learn, whether we should be going ahead with the sell put or we going ahead with the sell call. If we're going ahead with the sell put, in this eventuality, we need to understand that if the market trigger a lower side due to the geopolitical issue, due to any other factor, we are simply losing it because the profit which we made is much lesser than the cost we would be paying from our own pocket. And considering the current economic scenario, the current geopolitical issue, the current the war kind of scenarios, the inflation outlook and all these, it is almost impossible for anyone to predict that the markets may fall or the markets may go up. Because we are price takers, we are not price makers. One thing which we really need to understand that, but that's an unfortunate part, that we feel that we are price maker and we are not taker. That's an unfortunate part. Another important thing which we need to learn is that when it comes to the sell call, here again we are making money, but very important thing is that here also if the market go up, which is technically called reversal point. And remember that reversal point is never been a one-side story. Example I show you, suppose index falling and here you bought it. Suppose the market go up and again it falls. Suppose again go up, again it falls, again go up, again it falls. There are ample evidences in the world. One statement of a politician, statement from a respective central bank, and people can take any other meaning of that. Then what you would be doing? You would be losing. Henceforth, ladies and gentlemen, I strongly feel that when it comes to sell put, it is always safer when it compares to sell call, because remember that sell call is having a single thing which never goes in our favor, which is called drift. By drift means a push which can take our positions up. And we never know about the drift. We never know about the drift because, ladies and gentlemen, drift is created by the people who creating the price, not by the people who are accepting the price. Henceforth, I strongly feel that on technical grounds, when it comes to sell put and when it comes to sell call, it is called drift. And that drift is fairly impossible to compute. It's fairly impossible to assume because we are price takers, not makers. Henceforth, ladies and gentlemen, when it comes to index replication strategies, then do remember one thing, the following points. Point number one, are you a cash trader? Point number two, do you understand the options very well? Point number three, are you going ahead with sell put knowing all the risk and returns? Point number four, are you going ahead with sell call knowing all risk and returns? Do you understand the difference between sell put and sell call, which by the way is technically known as drift? Good evening, ladies and gentlemen. This is Rahul Magan, your friend. In this video we shot exclusively for our learning platform, TRFX.